Okay. But so far you have learned from the portfolio class that portfolio can be thought of as a combination of kind of risky securities and risk-free securities, uh, which is very plain vanilla concept of portfolio. That portfolio includes some risky assets and risk-free assets, and based on the indifference curve of the individual investor will decide in which point of the efficient frontier he wants to lie or he wants to invest. Okay, but the thing is that other than the factors which is risk-free rate and the index which represent the risky assets of the risk assets which exist in the market, there are some other factors, some other influences which will have influence on your portfolio return. So if we do not include those factors in assessing or measuring the performance of the fund, we may mistakenly conclude that this additional return is coming from uh, some sophisticated skills of managers. So you probably have already learned that the market return or the market access return and the proportion or sensitivity of the portfolio to this market access return is not the only factor which determines or which speaks about the return of the portfolio. Rather, you have learned from the arbitrage pricing model in your investment analysis so far, and also from some discussion of the asset pricing model like Pharma Friends 3 factors model or Pharma Friends 5 factors model. You have learned that other than the beta, there are some other factors which can explain the return of the asset, security, or portfolio in aggregate. So in multi-index benchmark, what we have introduced in previous class, that in addition to the single index or the market index, which represents or which is expected to represent the approximate or approximately all risky assets in the market, there can be some other factors or forces which influence the return. And in single index benchmark, we only include the market index. We do not include other index which may represent the characteristics of my portfolio, which may represent the securities of my portfolio, which may represent the securities nature of my portfolio. But multi-index benchmark asks us to include some other indexes in addition to the market index to precisely estimate the return or to precisely estimate the performance of the portfolio. So the question is now which index we need to include, in the portfolio, or which index we need to include in assessing the performance of the portfolio. So the answer is dependent on some conditions, and first suggestion is that we have to include index which represents the securities which are held by our fund also. So for example, we commonly include the market index, so which is a kind of general market index and which includes all the securities or approximately all securities. So we can include the DSEX, or we can include the S&P 500, or we can include the Dow Jones, these things. or we can include the CRSP value weighted index, this index. So it is based on the idea that this index include the securities which are also in my portfolio. Now, if your portfolio is a kind of, for example, bond fund portfolio, and it is a kind of, for example, pure bond fund, and you do not have any share or any stock in your portfolio. It's a kind of pure bond portfolio. You have corporate bond, you have government bond, or you have treasury bond, you have municipal bond, these bonds. So in that case, for example, in my country, in that case, if I include DSEX, if I include DSEX as a index, does that index represents the type of securities held by my bond fund? What do you think? Have I got the question? The fund we are considering right now is a kind of bond fund, and the index which we are proposing to include to assess the performance or to determine the alpha, that index includes only the stocks. Will this procedure be acceptable? You are there with me? Yes, no?
Yes, sir.
So will it be valid if we include the DSEX index to assess the performance of a bond fund?
No, sir.
Why not?
স্যার ডিএসইএক্স হইতেছে বেসিক্যালি সিকিউরিটি স্টক গুলাকে করতেছে, কিন্তু বন্ডকে এক্সপ্লেন করতে পারতেছে না, মানে
Okay,
মেজর টাইপ হইতেছে
there is no place of bond in the DSEX index, right?
Yes, sir.
Okay. Now the thing is that you probably have heard about Dalton Gruber as a textbook authors.
Yes, sir.
Of the textbook we are following, and they are very good researchers in assessing the cross section of mutual fund performance. In their text you will see a good number of reference of their own papers, and they have found that a 3-index model is more appropriate, and they have suggested 3-index in assessing the alpha. So how we are assessing the alpha? You probably have heard about the Jensen alpha from your another class, portfolio management.
Yes, sir.
Yes, sir.
How many indexes are covered there?
Three
What is the
texts. DS30,
one index?
DS30, DSEX, or DSE Sharia index.
These are alternatives. These are alternatives. Okay, but all are representing the stock market index?
Yes, sir.
Okay. So Alton Gruber and Blake suggested that we have to include the market index. The example is kind of DSEX, what you just have mentioned. And we also have to include the index for a smaller stock. And we also have to include the stock, an index for bond. So it is based on a findings of another study of Ippolito. Ippolito, you would find this reference in your text, that they have found that if we include, if I write here the portfolio return, portfolio return. How can we get the risk premium of the portfolio? Is it the way how we get the risk premium of the portfolio?
Yes, sir.
Okay. So how can I write the Jensen alpha equation? I have to begin with the alpha. Then I have to write the beta. Beta represents what? Beta represents what? I know you know it very well, but I just like to know it again from you.
So market
For
sensitivity.
systematic risk.
It represents systematic risk. Okay. If I write here the market return and the risk-free rate. Now, based on the equation, what you would say about the about beta? What does beta represent from this equation? Theoretically, it represents the systematic risk. If all other things remaining same, if beta goes up by 1 unit, can you expect that it will directly influence the excess return of the portfolio? Have you got the question?
So excess return বাড়বে.
So can we say that excess return is directly proportional to the beta? Do we have anything to do with this? Can portfolio manager has any discretion on this?
No sir, he has no
Portfolio
discretion over
manager has
RM.
full discretion on what?
Beta.
He can take higher beta if market is expected to go upward, and if market is expected to go downward, he will try to reduce the beta. Okay. So the thing is that when we are talking about multi-index, how many factors we have to add? We just have mentioned about 2 additional index. One is for a small stock, another is for bond. Okay. So if you find, I can write here, say, if it is beta 1, you can say beta 2, and we can write here the return for small stock over the risk-free rate. And I have mentioned another index, the index for bond. Okay. So for bond index, there are return for that index. So there is, you probably have heard about the Lehman brothers, which closed their business or which were bankrupted in the last financial crisis. Have you heard about Lehman brothers?
Yes, sir.
Okay.
Yes, sir.
So Lehman Brothers is popular for introducing or for maintaining one of the most popular bond index. So if you take the return of that index, which I'm mentioning here, return from bond index, and if you take the excess return, we always have to take the excess, okay, or the risk premium. Now, how many indexes I have included here? 1, 2, or 3?
Sir, 3.
It is 1, it is 2, it is 3. So we always are concerned not with return, but with excess return. We are always concerned alternatively with risk premium. So when we are talking about return, actually we are mentioning about the excess return. We are not talking about return including the risk-free rate, the return which is available if you do not do anything, or if you just put your money in the risk-free asset. We are not talking about that return. We have to skip or we have to exclude that available return from the return we are considering. If the stock market is here, we have to exclude the risk-free rate from here. Okay. So the thing is that it has been found that what I also have mentioned in the previous class, that if we just skip this part, or what Alton Gruber found, if we just include this and do a time series analysis, can we do a time series regression if we have this data for each month, and if we have data for this month and we do a regression, can we have this alpha and the beta measurement? Will it be available to us?
Yes, sir.
If we do a regression?
Yes, sir.
Okay. It has been found that this alpha is very, very significant. What does it mean in that case? In that case, it represents that or it gives a signal that the benchmark, what I have taken, is not adequately capturing the risk which are exposed by this fund or this particular portfolio. So when the alpha is very significant, there are two answers to this question. One answer is that if the model, what we are considering, is perfect or is appropriate, or the index is very appropriate. For example, think about a passive portfolio. What does passive portfolio do?
স্যার যে কোনো একটা ইন্ডেক্সকে ফলো করে।
It mimics the index portfolio. Okay. So in that case, which index you will include in this benchmark? Only that index which is followed by the passive portfolio?
Yes, sir.
If the portfolio is passive, which index we should include here? The index which is mimicked by that portfolio, we have to include that index here. And if we see the alpha is significant, can alpha be significant if the portfolio is passive? When it is expected that alpha is significant, in active or passive? Have you heard about the active investment and passive investment? In passive investment, we directly or we mimic a particular index we do not have any active allocation. Active allocation, what does it mean? It means that, for example, that index allocates 10%, for example, in the engineering sector. And if you're a passive portfolio manager, you have to allocate how much in the engineering sector? 10% or more than this, or less than this? If you're a passive manager,
So 10%.
10%. Okay. Now, if you do 8%, you are now passive or active?
স্যার অ্যাক্টিভ হয়ে যাবো কারণ ইন্ডেক্সে ফলো
Because you are not
করতেছেন।
following, you are not mimicking, you are not mimicking the index. Okay. Now, so one thing, you have got the active allocation in a particular sector. Another thing is that how can you perform better than the index, that if you do invest in a security which is not included in that index. For example, you have invested in a security which just has been issued recently, and it is yet to be included in the index. In that case, you have selected a security which is not included in the index. In that case, are you a passive fund manager? You are no longer a passive. You are doing an active allocation in a particular security because you have selected a security which is not in the index. So the thing is that when you are doing this active allocation and active security selection, when you are doing this, it is expected that your alpha is to be significant, because your alpha represents something beyond the return which is explained by the index. And if you are a passive fund manager, your alpha is expected to be 0, because all of your return of the portfolio is expected to be explained by which index? The index which you are mimicking. Have you got the issue? If you are a passive investor, which will explain your return? The index which you are replicating. And if you are not a passive investor, in that case, other than the index, which is the aggregate market index, there may be some other, if there are no other factors, and let's say from the portfolio return is say 10%, and from your beta measurement, say excess market return is, say your beta is 2, excess market return is 4%, and how much is alpha now? 2%. So 2% is alpha. So it is only possible to have the significant alpha when you are an active fund manager, not a passive fund manager. If you are a passive fund manager, your 10% total return is expected to be wholly explained by which one? Your exposure to the index. Okay. So the thing is that it has been found that when we only include stock market index, we get or Alton Gruber found a significant alpha. And they also have found that alpha measures what? Alpha measures the fund performance, in addition to the performance which can be explained by its exposure to systematic factor. Okay. But alpha has been found significant. And they have also found that small stocks, the funds which include the small stocks, they have higher alpha, and also the companies, the funds which have higher fees, The funds which have higher fees, they also have higher alpha. So do you know how can we get the smallest stock? What's the benchmark to get the smallest stock? How can we recognize that a stock is a small stock or a stock is a bigger stock? How can we measure it? If we know this, the answer is yes, we know. This is in this way. If we do not know, no, we do not know. Yes or no?
স্যার মার্কেট ক্যাপিটালাইজেশন এর উপর বেস করে।
Okay, so why you are waiting so long to give this answer? Okay, the market cap. So based on the market cap, we can classify the stocks in the small stock and the big stock or the mid cap stock based on how many classifications we are making. Okay. So it has been found that the fund which include or which has the small stocks, they have higher alpha, and the funds which have also higher fees, they have also higher alpha. Okay. Can you tell me which fees mutual funds are exposed to or mutual fund investors are specifically exposed to? You are supposed to learn it from the financial markets and institution course. Which fees mutual funds investors are exposed to? Have you seen this kind of fees for mutual fund or learned? Yes or no?
স্যার ফ্রন্ট লোড আর ব্যাক লোড এই দুটো টার্ম আমরা শুনেছি। ফ্রন্ট লোড আর ব্যাক এন্ড লোড
Okay.
মিউচুয়াল
What about?
ফান্ডে।
Okay. So from the management fees, right? The name implies it is kind for the managers, the administrative fees, fund administration fees, and there are 12B fees. It is for the fund distribution fees. If you go for distributing the fund to the investors, you have to incur some promotional expenses. Those expenses are covered in the 12B fees. So it has been found that the funds which have the higher fees, they are also giving higher return, or they are reporting higher alpha. But when the Alton Gruber included an index which represents the return for a small stock and also included an index to represent the return for bond, they have found that alpha has become now insignificant. So first of all, the thing is that have you learned from the Pharma Friends 3 factors that smaller stocks outperform the biggest stocks?
ইয়েস স্যার।
What is the reason? What is the reason? Is there any convincing reason that why smaller stocks tend to outperform the biggest stocks over time? And it has been observed for a long years.
ইনভেস্টরদের সেন্টিমেন্টের জন্য।
How? Investors has higher sentiment for smaller stocks like this kind of, or poor sentiment for a smaller stock? I mean, when you are talking about sentiment, there should be a
গ্রোথ
logical.
পটেনশিয়াল যেমন বড় কোম্পানিগুলো ওদের তো গ্রোথ অলরেডি একটা ম্যাচিউর স্টেজে চলে গেছে, বাট যারা স্মল স্টক কোম্পানি ওদের মানে গ্রোথ পটেনশিয়ালটা একটু বেশি থাকে। মানে মানে ইনভেস্টররা অ্যাজিউম করে যে ওদের গ্রোথ পটেনশিয়ালটা একটু বেশি, ওরা আরো মানে গ্রো করতে পারে, এই কারণে হয়তো
Growth
প্রাইস
is a
বাড়তে
separate chapter. Growth is a separate chapter. I just have mentioned about the size. You need to confine your discussion with the size. In which stocks investors has more concentration? I mean, investors are heavily concentrated on which stocks? A small cap stock or large cap stock? What do you think? I probably mentioned about it in one of our previous classes. If I ask for some stocks from you, which stocks will come first in your mind? The large cap stock or a small cap stock?
So large cap.
Large cap stocks will come first in your mind. So if many investors go after the large cap stocks, they tend to be undervalued or they tend to be overvalued?
So overvalued থাকবে।
They tend to be overvalued, and the opposite thing is expected to happen for the small cap stock.
Yes, sir.
In that case, what should be the strategy? To go for a small cap stock?
Yes, sir. কারণ small cap যেহেতু undervalued আছে, future price বাড়বে।
So there are some other plausible reasons which are proposed to explain why a small stock should outperform, why big stock should underperform in future. Okay, so when Alton Gruber has included this return for small stocks over the return for big stocks, can you recall that in previous class I showed you the site of K-French where the market return, the return for a small factor, return for size factor, return for growth factor are given? Can you recall? I showed you that Pharma French presents this monthly return for these factors. Okay, it is monthly. Okay, you see this return represents what? This return represents what? What kind of return this return is? Market return or excess market return?
Sir, market risk premium.
Market risk premium. What does this return represents? This return represents the return of small stocks over the return of big stocks, small minus big. This SMB represents what? SMB, small minus big. Okay, sometimes you see that the number is negative, sometimes you see the number is positive. When in the month in which the number is positive, what does it mean? Small stocks outperform or big stock outperform? When the number
Small stock outperform big stocks.
okay, and the opposite is true for the negative sign?
Yes, sir.
Okay, and this is for the HML, and high minus low. High means high book value to market value. High book value to market value. So high book value to market value. What kind of a stock it is? If the stock looks like this, if I write this, book value is greater, market value is smaller. What kind of a stock this is from your investment analysis course? This number is a bigger number, book value is a bigger number, market value is a smaller number. Is a kind of,
Undervalued.
yeah, undervalued, but there is a specific term by which we recognize this kind of a stock. We recognize this stock as value stock. Is it true? If the book value is a big number, market value is a small number, and we see this ratio is high, in that case, how can we recognize these stocks, value stocks? Have you heard about the growth stocks? Have you heard about this term?
Yes, sir.
When we recognize some stock as growth stock, when this ratio is a higher number for higher market value, lower book value. Is it true? Okay, you should cover it from your investment topic. It is not here for discussion. Okay, so the thing is that when we include the index for a market, and when we also include the index for a small stock, what I just have shared, that how we should write here, and we also include the index for a bond fund, say like this, for bonds, not bond fund, we get the excess bond market return. And in that case, it has been found that the reported alpha has become very insignificant. Now, if for extension of this benchmark or extension of the Jensen alpha model, the alpha has become insignificant. Now, what will be the answer when for the question why the initial alpha was higher? Is it for the reason that managers outperform really, or the benchmarks what we fixed or what we took are inappropriate to capture the return of the portfolio? Did the manager really outperform? If you do not include this, it was found very significant. But when these additional benchmarks have been included, the alpha reported was very insignificant. Now, which answer is more plausible? Managers really outperform? Managers should be given credit for outperformance, or the performance based on the benchmark or on which the performance was measured was not appropriate?
Sir, benchmark was not appropriate.
Benchmark was not complete to capture the performance of the portfolio. Okay. Okay. Now, next thing, what I like to highlight right now, the second point, index. So first of all, the first point you have got you have to include those indexes in your performance measurement, which represents the securities of your portfolio. So this is the first point. Second point is that based on the characteristics of securities, we also have to include some indexes, or we can go for including or selecting the indexes. For example, you have learned from the Pharma Friends 3 factors model, which stocks outperform other than the return explained by the market return, which stocks outperform, big stock or a small stock?
So small stock.
Stocks, and small stocks are outperform. And which stocks also outperform? Value stocks outperform. So which stocks are value stocks? The stocks which are trading at a value less than their book value, or which are trading at a very lower in proportion to their book value. Their market value is very low, but their book value is a big number. Okay. So the thing is that this small or the value are kind of characteristics of the stocks. Some stock is small, it is kind of an attribute of that stock. So based on the attribute of the security, you are planning to include some index. Now, in addition to the return, what I just have showed to you from the Pharma Friends 3 factors, small minus big return or the high minus low return, you can alternatively include an index which only includes all small stocks. The index is not only always about the market index. Index can be formed by any composition. Now, what kind of index right now we are talking about? The index which represents only the small stocks. Now, if I ask for a small stock index in the USA, can we expect that Apple is there in this index?
No, sir. Small
Apple is
stock
not
Apple থাকবে
expected
না।
to include there because Apple is a kind of large cap stock, right? Okay. So there are also other indexes which are known as value indexes. So which represents what? This index includes which securities? Includes only those securities of which this ratio is a higher number or this ratio is a lower number. If I ask for a value index, this this index is expected to include which stocks or which securities in its composition? I just have mentioned which stocks are value stocks, which stocks are not value stocks. If the opposite is true, market value is a bigger number, book value is a smaller number, those stocks are growth stocks. And if the book value is a higher number, market value is a smaller number, those stocks are value stocks. Okay. Now, if I ask for value index, which stocks are expected to include? For the stocks of which the number, this number is bigger or this number is bigger? Of which the book value to market value number is bigger, because those if the ratio is a higher number, this ratio represents that those stocks are kind of value stocks. Okay. So other than the Pharma Friends 3 factors model, where the small and the value size and value attribute of the stocks have been identified, have you heard about the momentum return momentum? Have you heard about the momentum stocks from your investment analysis course?
স্যার টার্মটা অন্য জায়গায় শুনছি বাট ওই কোর্সে এই টপিকটা পড়ায়নি মোমেন্টাম।
Okay. Where you have heard about this term, momentum? I mean, out of the finance course?
সিএফ এর একটা কোন রিডিং এ নোটিস করছিলাম, এক্সাক্ট মনে পড়তেছে না।
Okay, fine. So if it has been found that the stocks which performed very well in past are expected to outperform in future, those stocks have momentum characteristic. And if it has been found that the stocks which performed poorly in the past, and if these stocks are also performing poorly in the future, those stocks are attributed as, those stocks are known as, those stocks are also have momentum characteristics. Okay. So how long you will look at the past? If it is, for example, if you find that a particular stock A performed very well in last 12 months, and if you see that they also outperform in, for example, next 3 months after these 12 months, in that case, this stock has a kind of momentum characteristic because they performed well in the past and they are performing, they are expected to outperform in the future also. Okay. So there is also possible to include an index which represents the return for the momentum factor. So if we sort the stock based on this momentum characteristic, based on the, so which stocks will be in the first quartile, in the momentum factor, the stocks which performed well in the past, the stocks will be in the first quartile, and the stocks which performed very poorly in the past, those stocks will be in the fifth quartile. Okay. Now if you get the difference between the return of, for example, the return is here 10% of this average return, and here the return is, for example, 1%. In that case, for that particular month, for example, it is January 21, for this particular month, the momentum factor return is to be 9%. Very simplistic understanding. Okay. So in this way, you just have got SMB, HML, and based on the momentum factor, it is also possible to get the return for momentum factor. Now it has been proposed that the funds also include the securities which performed earlier. So in that case, in the benchmark, you should include a factor, or you should include an index which represents the return for momentum. So how many factors right now we have got for pharma friends? 3 factors, and momentum and additional factor. How many factors we have got in total?
So 4 factors.
4 factors. So how many factors are in pharma friends? 3 factors. There is a market factor, there is a factor for a small minus big, there is a factor for high minus low, and we also have got a momentum factor. And it has been proposed by a seminal paper, Jagadish and Treatment. And if you include these 4 factors in measuring the portfolio of your, in measuring the performance of mutual fund portfolio, it is understood that you are using Carhart model. You are using Carhart model because Carhart was the first who estimated the mutual fund performance by taking all these four factors. Okay, so based on the security characteristics, you can include some indexes. Okay, so this is the number 2. Now the number 3 is a kind of comes from quantitative analysis or econometric analysis. Have you heard about something called principal component analysis or PCA analysis? Yes or no?
No, sir.
Okay. Now, if I ask for how many rates, how many interest rates are there in the monetary environment in our country, do we have only one rate or we have more than 20 or 30 rates? I mean, if I ask for the interest rate, for example, how many rates are available? There are several number of interest rates.
Yes, sir.
Okay. Now, if I ask for the economic parameters, how many parameters are available? For example, we have per capita income, we have the GDP growth, we have economic development or economic vulnerability index, then we have human development index, then we have climate index. A good number of factors, a good number of variables are there. Okay. So the thing is that when we have a number of rates, for example, let's think of we have n rates. Okay, we do not know how many n's are here. It can be 20, 40 or more than that. Okay, do you believe that there should be a covariance between the rates in the n rates, or the covariance there should be no covariance? I mean, the covariance is very kind of always 0. Or you expect some covariance between the rates which are included in the n number of rates?
স্যার কিছু কোভ্যারিয়েন্স থাকতে পারে।
Okay, so if I just try to give you a very specific example, for example, interest rates. If you take 20 interest rates in our country, for example, from the, for example, if you start from treasury rate and you take the deposit rate, you take the lending rate, you take the corporate borrowing rate, you take the SME rate, and you have taken approximately 20 rates, what kind of covariance you expect? It should be very high level or very low level? Interest rates move together. Yes, no? There is no option to keep silent. You expect something very high covariance among these rates, or you expect something very low covariance among these rates, or you do not know? Which answer you want to pick? No answer? Should I ask you by your name? Okay, the understanding is there should be a high covariance because we are talking about interest rates in particular, and the economic variables are also in fact have a very high close relation or moderate close relation. It is not necessary that there should be a very high close relation, but based on their covariance analysis, it is possible to find out only very few only few variables, say 2, 3, or 4, which can explain approximately, for example, a very high percentage of the variation of this rate. Say, for example, 95% variation of the n rates, or you can say, for example, here n is equal to 20 rates, can be explained only by 2, 3, or 4 variables. So this kind of analysis is known as principal component analysis or PC analysis. Now, when you have only 2, 3, or 4 variables based on which you can talk about 20 rates, approximately 95% variation, do you need to analyze the 20 rates individually, or you need to be happy with these few rates? Because based on these variables, you can speak about what is going to happen these 20 rates. Is it plausible? I see no answer. I listen, no answer. Yes or no? The answer is not convincing. I do not get it. Shojib, you are there?
Yes, sir.
So are you getting what I'm trying to say?
স্যার মোটামুটি বুঝতে পারছি স্যার, একটু প্যাচ লেগে গেছিল আসলে কিছু আগে, তাই অ্যানসার দিতে পারছিলাম না।
Okay, you have to at least try so that I can take you to a level, then your answer will be complete. Okay, so when you get only few of these variables, 2, 3, 4, you can speak about 20 rates. So this is the purpose of principal component analysis. Now, if I ask about the index which are in existence in our world, how many indexes exist in the world? More than 10,000? Or it is within 100? Which one is plausible? How many indexes are available in the world or in the financial market in a specific? I do not know the answer. I just try to get your idea that is it within 100 or it should be more than 100, kind of 10,000. Okay, the number is a very big, and you sometimes find that some authors used kind of, you see how many indexes we have used here? Only 3. Some authors have used 16 indexes based on the securities which are present in the mutual fund portfolio. For example, let me give you an example how 16 indexes have come. For example, you have got the reason why market index should be included, and you have to understand why a small index which represents the smallest stock return has been included, and you have to understand why value stock index which represents the return of value stock is there, and we also have talked about momentum. And some stocks, some stock fund, though they are known as stock fund, they include treasury bonds. In that case, do you feel that there should be an index which represents the return of treasury bill? Treasury bond. And if it is such that there is some, there are some stocks in the portfolio which are foreign stocks, do you feel that there should be an index which represents the return of foreign stocks? It is based on this understanding, based on the major type of securities held by a fund. And if the stock, though the fund is known as a stock fund, don't get confused that the fund is purely equity fund. The stock fund can allocate, for example, 10% of its fund in the bond. It will be still recognized as a stock fund. But when you will see their composition, you will see they include some bond. And in our country also, the mutual funds are commonly known as equity fund, but you will see that they have started investing in the fund. They have started investing in bond. Though they are continuously recognized as equity fund, they are no longer as purely stock fund or purely equity fund. In that case, should we include an index which represents the return of bond? Now, how many indexes we are approaching to? A good number of indexes. If we go for continuing, if we go for understanding all of the constituents of our portfolio. Have we got the reason why an author used 16 indexes to measure the performance of the fund? Yes, no? So when we do some principal component analysis or factor analysis, it becomes possible to reduce the number of indexes what is expected to be used in general without using the PCA. For example, without PCA, we are expected to use the 16 indexes. But if PCA gives you that only 3 indexes are adequate to cover the variation of these 16 indexes, in that case, we need to be happy by using how many indexes? 3 indexes. Okay. So that is how the factor analysis or principal component analysis or PC analysis works. Okay. Now, thing is that in case of performance analysis of the portfolio or fund, what kind of measurement we have to take? So first of all, there are 2 approaches. For example, you have got the benchmark, how we get the how can we get the alpha, or what kind of model we are expecting to use. Say this is a multi-index benchmark model we are expecting to use. Now, these returns are already available. For example, from Pharma Friends 3 factors model, these returns are available in our hand. We do not need to calculate it. The purpose is right now, how can we get the alpha? So what is needed? We need to have the approximation of the beta of our portfolio. This is required. And we know how much return portfolio has generated. So what is the purpose of knowing this alpha? To know how much manager has outperformed the benchmark or manager has underperformed the benchmark. So the beta has to be estimated. So how can you estimate the beta? I believe that you already have heard about how beta is estimated. How beta can be estimated of a security? Do you know how to measure the beta of a security? Or it is available, readily available in Stock Bangladesh? You take the beta from Stock Bangladesh site and you conclude based on that. Sayeda Nabiha Ferdos, you are there?
Yes, sir.
Okay. Do you know how to come up with the beta? For example, how can we come up with the beta of our portfolio based on market beta? How can we get this? Have you heard about the time regression? Or we do not know about regression? Do we know how regression works? Regression gives us beta. So if we do regression analysis using this return and this return across the time, say month 1, month 2, month 3, let's say it's about 60 months. And for each of this month, if we take the portfolio return for each of this month, and we take the excess market return, which one should be independent variable? Which one should be dependent variable? For regression? Abdullah Noman, you are there? So market return should be independent variable and my portfolio return is dependent variable, obviously excess return in each case. So if we do a time series regression for using this 60 months data, we'll get a beta. And the procedure is use this beta as an approximate beta for the month 61. How many months we have taken? Up to 60? From first month to 60 month. How many years have been covered? 5 years. And if we take the market return of the 61st month, and if we multiply this by the beta, which have been approximated from here, we get the return which is explained by the market index. And we know what is already here. And now, say for example, this is 8%. Say this is 9%. In that case, how can we get the alpha? Just by doing some rearranging, we get the alpha of 1%. So this is kind of simple demonstration that how beta is to be estimated. Now the question is, from which data we have estimated beta? Last 5 years data. We have, this is a typical procedure how we get the beta. Now what we have considered that the beta what was existing in this 5 years, last 5 years or last 60 months is expected to remain stable in this 61 month also. This is the concept of using the beta as an approximation. But the thing is that it has been found that beta is not stable over time. Beta is not stable over time. We are right now considering which beta? Mutual fund portfolio beta. So if beta is not stable over time, in that case, is it wise to use the portfolio beta over time and consider it as approximate of the beta to be happened or to exist or to remain exist in the 61st month? Because it has been found that beta is not kind of beta does not move in this way. Beta moves in this way. So what does it mean? Across the time, if it is time and you look at the beta does not move in this way. Beta moves in which way? Beta moves in this way. What does it mean? If beta does not remain stable over time, beta goes up, goes down, and beta exhibits instability over time. In that case, using the beta from past time series to approximate the beta for future, will it be very plausible? In that case, approximation of beta will give us a wrong approximation for the beta in future, because beta is not stable over time. If beta is stable over time, in that case, it is possible to use the beta from past time series and use it the approximate beta for future. But it has been found that beta remains unstable over time. Beta varies over time. Sometimes beta goes up, sometimes beta goes down. So in that case, it has been suggested to use the beta based on the portfolio holdings. Based on the portfolio holdings instead of the beta measured directly from the portfolio return. It is the portfolio return based on which we have approximated our beta for portfolio. But it has been suggested to use the portfolio holdings to estimate the beta. In previous sessions, some of you have suggested how to use the portfolio beta based on the portfolio holdings. Can you recall? How can we get the beta from the portfolio based on the holdings? We need to have some data. We need to have some data which represents the stocks investment relative to my total investment, which represents the weight. And based on the time series analysis, we can also get the beta of stock. Beta of stock. In that case, if we multiply the weight of the stock and the beta of the stock for the k number of stocks which are in my portfolio, in that case, we can get the portfolio beta. Okay. So in addition to using the portfolio holdings to approximate the portfolio beta, there are some other suggestions which are known as Bayesian analysis, and also using the conditional models. In Bayesian analysis, we use the prior belief regarding the alpha of the fund based on fund's past performance. So, and we adjust this prior belief based on the available data. But which is our focus here, that what the things we need to keep in our mind when you go for analyzing the performance of mutual fund. So the thing is that we need to keep some issues in our mind, which are kind of very summary what we have discussed so far. That if I just try to show you a portfolio of one of our mutual fund which is operating in our country, these are some stocks out of its portfolio up to this Robi Axiata Limited. You see from my screen, from Bank to Robi Axiata, all these are stocks which are expected to have inclusion in the DSEX. They are included in the DSEX. But can anyone tell me that Green Delta Mutual Fund, DVH First Mutual Fund, Southeast Bank First Mutual Fund, Ekusha First Unit Fund, Zenith Annual Income Fund, in this fund in which this fund has invested, these funds have been included in the DSEX? Yes, no? Do you know which stocks have been included in the DSEX? These stocks have been included in the DSEX. How many? 304. So I know you know how to get this list. From here, you get the DSEX, DSE indices. If you go to the DSEX index, or if you go to DS30 index, you will see the list of constituents which have been included in this index. Now, if I ask you, other than this fund, look at here, this fund has also invested in the IPO. Okay. So if this fund has invested in the IPO, and this fund has also investment in other mutual fund, does this investment can be comparable with the DSEX? Does the DSEX constituent represents this, which I just have mentioned here? Can you hear me? Ashraful Alam? Saurabh? Shojib? No one is there? Akash? Sadia?
Yes, sir.
You're there?
Yes, sir.
Okay. Do you feel that DSEX includes these securities which are held by this fund portfolio?
Yes, sir.
The DSEX is here. You see the DSEX, this one is DSEX index constituents. Okay. Now, if you look at the DSEX constituents and you see the constituents of this fund portfolio, these investments are included in the DSEX. This investment in mutual fund, I mean, these mutual funds are listed in the DSEX index. Okay, give me simple answer. This APSCL bond, this bond is included in the DSEX index. What do you think? DSEX represents any investment in bond?
Sir, DSS is the index for the security market, security or stocks. So I don't think that this bond will be included in this stock in
So
this.
in that case, if this fund uses only DSEX, and if any investor estimate the alpha of this fund just by including the DSEX index to represent the index for risky portfolio in the market, in that case, alpha approximation or alpha estimation will be precise or it will be incorrect.
Sir, it will be incorrect.
It will be incorrect. So that is the first learning, that single index model is not acceptable in general, but sometimes if a mutual fund is a kind of managed passive portfolio, mimic this, for example, DS30. In that case, what does it mean? It actually, the DS30 actually reflects the portfolio of this passive fund. In that case, if this passive fund includes the DS30 index, or investor use this DS30 index to estimate the alpha of this passive fund, in that case, is it okay?
Yes, sir.
In that case, is it okay? But what do you expect? The fund manager will have a significant alpha or insignificant alpha. If the fund manager is a passive fund manager, he mimics the DS30. It is expected that alpha should be insignificant because the return of his portfolio is expected to be solely explained by the movement of DS30 or movement of this index. Okay, but in case of active portfolio or active fund manager, the single index benchmark is rarely inappropriate. It's really inappropriate. So we have learned what kind of indexes we have to include. And another thing we have to bear in our mind, that sometimes, not sometimes, usually funds represents return. Do you know how to estimate the mutual fund return? Very simple approximation. How can we get a return approximation of a fund, mutual fund? I mean the return what I wrote here. This one. Are you familiar with this kind of simple approximation?
Yes, sir.
Okay, the thing is that we need to be cautious that when we go for estimating this kind of return calculation, first of all, we need to include, or we need to assume that, or we need to adjust our NAV in such a way that dividend disbursed by the fund has been reinvested in the fund. Dividend which have been disbursed by the fund has been reinvested. And another thing which we'll have to reflect, that is it adjust, this NAV has been adjusted for management expenses and the 12B fees. Can you recall we have mentioned about these fees? So why we have to adjust this fees? Because we will not get the true performance if we do not adjust the NAV for these issues. So we have to adjust for these expenses and this dividend. Now, can you recall in previous class I showed you a database in which mutual fund return and mutual fund performance are available? I have mentioned about a database provider, CRSP. So CRSP reports that they measure the return in this way. So cumulative factor is a separate thing for which there has been a explanation, but which is required for our simple approximation is that NAV should be adjusted for what? All management expenses and 12B fees. And the alternative name of the back-end load, what Khalid has mentioned, is the rear load fee. The thing is that front and rear load fees are excluded from the calculation of NAV and therefore do not impact the calculation of return.
Sir, what do you understand by the 12B fees?
12B fees are the fees incurred by the fund to distribute the investment unit. For example, fund has to incur some promotional expenses to attract the investors. Are you familiar with this? If a fund has to reach to the investors, fund has to incur some promotional expenses.
Yes, sir.
Okay, those expenses are covered in 12B fees. Okay. So that is the issue, but the thing is that it has been found that before considering fees, mutual fund reported a good percentage of alpha. You see, based on the holdings data before expenses, these authors have found that funds report positive alpha. But when expenses have been adjusted, the expenses what I just have mentioned, not the front and back end load, but the 12B fees and the management expenses, it has been found that in general, the alpha of the funds are negative or positive.
Negative, sir.
So can we conclude that mutual fund underperform the benchmark? Mutual fund in general underperform the benchmark?
Yes, sir.
So it represents that the fund manager are not expected to more smarter than the market. But in our country, it is very common to see that funds outperform the market because they use only the DSE X index as their benchmark. And what you have realized so far from our discussion that DSE X may not be appropriate to measure the alpha of our fund, and it is very hard to see that alpha has been reported by the fund manager in our country. So if you take the alpha, if you estimate the alpha by taking the return data and taking the appropriate benchmark of our mutual fund industry for our mutual fund industry, it is expected to see the similar kind of result that mutual fund are not expected to outperform the market after considering the fees or after considering the expenses which actually need to be realized by the investors. You see the management expenses, 12B fees will be realized from the investment made by the investors. But before expenses, it is expected to see that funds may report some slightly positive performance. Okay.
I have a question.
Sure.
In the return formula, you have showed that we have to multiply the cumulative factor. So
Yes.
what we understand with this cumulative factor particularly is the expense that we trying to add all the all kind of
No. The NAV has been separately adjusted for the expenses. Okay, NAVs have been separately adjusted for management expenses, 12B fees. And the cumulative factor is based on the trading pattern of the funds. It is based on the trading pattern and trading structure of the fund. Okay. Cumulative factor is not related to the expenses. Have you got it, Sadia?
Yes, sir.
Okay. Now the thing is that we are particularly interested in our class regarding the performance of bond mutual funds, how they have done. But it has been found that bond funds in general have been ignored in the mutual fund literatures, which is not expected because bond funds constitute a significant portion of return or significant portion of the assets managed by the funds. So I recommended you to go through this paper in previous session. This is one of the very first papers which attempts to understand the performance of bond mutual fund. So they have used several benchmarks to estimate the alpha of the bond mutual funds. So you probably have gone through this this paper, and you probably have found that they have used several models to estimate the performance of fund. So I just try to explain the one model or two models, so other models will be clearly understandable to you. So by the model, what I'm trying to mean? By the model, I'm trying to mean the benchmark multi-index benchmark model, what we wrote here. You see the multi-index benchmark we wrote here?
Yes, sir.
And in the paper, when I'm referring the model, it is referring the what kind of model they have used. For example, how many indexes they have taken for the bond fund. Okay. So in general, when we use the equity fund as a mutual fund for performance measurement, the Sharpe ratio, Traynor ratio, the Jensen alpha information ratio are very kind of not commonly used in academic literatures because they are not appropriate measure of fund performance, which is more appropriate, that is the multi-index benchmark model. But if your fund about which you are considering, if that fund is a passive fund, in that case, the single index benchmark can be appropriate because the fund is blindly following a single index. In that case, single index benchmark is appropriate. But in all other general cases, multi-index benchmark is more appropriate. So what kind of multi-index benchmark we use in the equity mutual fund or stock mutual fund in general? The Carhart 4-factor model. So which factors are included in the Carhart 4-factor model? We already have mentioned. Farmer Friends 3 factors: market risk factor, a small minus big factor, then value factor. Okay. So what is the fourth factor? In the
Momentum
Carhart
factor.
momentum factor. Okay. Now, in case of bond fund, when the portfolio major composition is constituted with bonds, which indexes we need to consider? We need to consider they suggested, for example, two different 3-index models. So what does it mean? How many indexes they have used? 3-index model. Okay, they have used in total 6
Sir,
models.
sir, for this particular chapter, is it enough to go through this research paper, or we have to also cover this from our book?
You will see a good number of reference of this paper in your chapter, but I will recommend you to go through the major contents or basic ideas from this paper so that your understanding from the text will be more concrete. Okay, so the authors of the book and the authors of this paper are same. Okay.
Yes, sir.
Okay, so what they have included, they have taken in the 3-index model, they have used the Lehman brothers. I just have mentioned Lehman brothers. Okay, Lehman brothers government corporate bond index. So what kind of bonds this index represent? Government bond return this index represent, and corporate bond index represent. Okay, so does this index represent any mutual fund, municipal bond? This index represent any municipal bond? From the name, what does it implies? It implies only it represents the government and the corporate bond. Okay, and it also this model, the Lehman Brothers mortgage-backed securities index. Have you come to know about the mortgage-backed securities from your financial markets institution course?
Yes, sir.
Okay, so sometimes it has been observed that funds also include the invest in the securities which are mortgage-backed securities, of which cash flows are directly dependent on the loan repayment from the mortgage loan. Okay, so that's why they have included this, and the blame came high yield index. So between the bonds, between two type of bond, for example, bond A and bond B, say bond A and bond B, this bond has a, for example, high likelihood of getting default, and this bond has low likelihood of getting default. And this company of which the bond is B is a kind of very speculative kind of company, and the company A for which they have issued the bond A, they are kind of very stable company, in which case the bond yield is expected to be high. In which case the bond yield will be higher in junk bond or very stable kind of bond, or say for example triple A rated bond, in
Junk
which
bond.
case the yield will be higher.
So junk bond.
Okay, now if your if your fund includes a good number of junk bond, or say for example this kind of low rated bonds, in that case you expect to have a higher return for including high yield bond. If the portfolio contains a good number of junk bonds, we expect to have a high yield, we expect to have a higher yield.
Yes, sir.
Okay, in that case the return the portfolio is achieving, or the portfolio is estimating, can be attributed to its holding of junk bond, or it can be attributed to the skill of fund manager. So two things are similar. For example, I'm an individual investor and another one is mutual fund manager. And if we do invest in both junk bond here and here, and we should have a higher return because junk bond provides higher yield. Junk bond provides higher yield. That's why we are expected to have a higher return. So in that case, the credit should be given to the mutual fund manager, or the credit should be given to the holdings of junk bond.
Holdings of junk bond.
Holdings of junk bond. Now, in that case, what kind of index I have to include to estimate the proper alpha? We have to include an index which represents the high yield bond return.
Yes, sir.
So that is the understanding of the Elton Gruber paper. And I like to conclude today's session just by showing you another one. Say here how many indexes they covered in another model where they have used 6 indexes. The Lehman Brothers Intermediate Corporate Index, Long-Term Corporate Index, and Mortgage-Backed Index, and the Bloom-Kane High Yield Index. How many indexes are here? 4. There are 4 indexes. One is Intermediate Corporate Index, another one is Long-Term Corporate Index, another one Mortgage-Backed Index, another one is High Yield Index. So you'd see some other index, some other models where they have used 6 indexes, where the macroeconomic variables also have been included. But can anyone tell me what is the difference between Intermediate Corporate Index and the Long-Term Corporate Index? How can you define the intermediate and long-term and the short-term in the financial market? What is the global practice?
Based on the timing.
Yeah, based on the timing, but what is the time frame?
So maybe usually 1 year to 5 years is in the intermediate.
Okay, if it is less than 1 year, we term it as short term. Okay, we term it as short term. Now, if it is less than 10 years, if it is less than 10 years, we term it intermediate term. If it is greater than 10 years, we term it as long term. If it is only 10 years, in US, you are not expected to get the 30 years nowadays. You are expected to get maximum 10 years. Okay. So less than 10 years is intermediate, but if it is 10 years, in that case, it is long term. So in this way, how corporate bond fund performance is measured and with what kind of indexes are taken. So in next class, what we are expected to discuss, these things are, we are expected to discuss that if the mutual fund performance is positive, do they continue to perform in the future? I mean, if a mutual fund performs well nowadays, can it be expected that they will also perform in the future? I mean, if you go for making investment in the mutual fund based on its high current performance, can you have higher return in future? So do they have the persistence of performance? We will try to give the answer of this question in the next class. And I will also try to show you the way how can we get the data from the data for the mutual fund and get the estimation of alpha and the beta and what is the reality of the mutual fund performance in next class. Okay, so that's all about for today. Let me